Interest rates have been on the rise lately. This can impact your credit card debt in a few ways. If you're one of the millions of Americans who have credit card debt, you may be wondering what the rising interest rates will mean for you. While it's still too early to tell exactly how this will play out, there are a few things you can do to prepare. In this video, we will discuss how interest rates can impact your credit card debt. What is an interest rate and how does it impact your credit card debt? Before we discuss how rising rates can impact your credit card debt, let's give you an overview on what interest rates are. An interest rate is simply the price you pay for borrowing money. When it comes to credit cards, the interest rate is the cost of borrowing money on your credit card balance. Interest rates are typically expressed as a percentage of your overall balance. For example, if you have a balance of $1,000 and an interest rate of 18%, your monthly interest charge would be $18. The higher your interest rate, the more you will pay in interest charges each month. While some people try to keep their balances low to avoid paying interest, this is not always possible or advisable. Interest rates are just one factor to consider when you are trying to get a handle on your credit card debt. Other important factors include your credit limit, payment history, and whether you have a promotional rate. Rising interest rate, how will it impact credit card debt? Credit card debt is one of the most common forms of debt in America. If you have credit card debt, you're not alone. In fact, the average American household has more than $16,000 in credit card debt. But what happens when interest rates go up? With the Federal Reserve expected to raise interest rates 3 times this year, many people are wondering how that will impact their credit card debt. The good news is that if you have a fixed-rate credit card, your interest rate will most likely not change. However, if you have a variable-rate credit card, your interest rate will increase along with the Fed's rate hikes. That means your monthly payments will go up and it will take longer to pay off your debt. If you're struggling to make your monthly credit card payments, now is the time to start working on a plan to pay off your debt. How to protect yourself against rising rates. There are a number of different ways to do this, but one of the best is to transfer your balance to a low-interest credit card. This will save you money on interest and help you get out of debt faster. Second, make sure you are paying off as much of your balance as possible each month and keeping your balances low. Maxing out your credit cards will not only hurt your wallet in the short term, but it will also damage your credit score in the long run. If you can't afford to pay off your entire balance, try to at least refrain from using your card for new purchases. Finally, improve your credit score by improving your payment history. This includes credit card payments, bills, and rent or mortgage payments. Payment history is one of the biggest factors in determining your credit score, so it's important to stay on top of things. Staying on top of your credit score and monitoring these key factors will help you to qualify for the best interest rates when it comes time to refinance or consolidate your debt. Following these simple tips, you can start to improve your financial situation and get on the path to a healthy credit score. There's no doubt that rising interest rates can be a nuisance. It is important to stay ahead of the game and understand how the rising interest rates will impact credit card debt. Americans have a lot of it, so if we can be proactive in our approach to paying off debt and maintaining good credit scores, we'll all be better off in the long run. What are your thoughts on the Fed's rate hike? Do you think it will have a positive or negative effect on consumers? Let us know in the comments below. Thanks for watching, and for more videos like this, please subscribe to the channel and hit the bell icon for notifications on future videos. See you in the next video. Until next time.